Right, good morning, everyone. As we enter European trading on Friday, the 7th of July, we got stuck into markets in the morning after a rout across the board on stock indexes, on bonds, and then the US dollar pushing higher as well. Yields globally pushing higher. The Aussie 10-year yield at decade-long highs. Sterling 10-year yield. I say sterling. UK 10-year yields, yields on gilts at decade long highs as well. Obviously, back down at those levels first reached by Liz Truss and Kwasi Kwarteng last year. That we obviously spoke about a bit yesterday in yesterday's videos, or in one of yesterday's videos. Now, as we head into today's European trade, market's a bit mixed, a bit of kind of pullbacks across these major asset classes, which is not unsurprising. I mean, after the moves we saw yesterday, which we'll go on to now in a minute once we get onto the charts, really not to be unexpected as we head into non-farm payrolls a little bit later on today. Now, you can see, if as wherever you look on the financial news sources, you'll see them speak about yesterday's ADP employment figures, which nearly hit 500k. Consensus was for 220 or 225 or something like that, and we ended up coming in, of close to 500. So, massive beat on employment figures yesterday. And is that a front runner into today's NFP release later on this afternoon? I have to imagine probably so. I mean, it's not always the correlation. You don't always get one strong and then the other follows. They can move in different directions. Obviously, one's private and one's public sectors. So, not exactly a front runner, but we saw some massive moves off the back of that yesterday, and it kind of fuels speculation that the Fed, are going to continue hiking interest rates aggressively on their fight against inflation. As long as the labour market remains strong, it will continue to put pressure on inflation, and as long as things continue to put pressure on inflation, central bank have more work to do in order to cool that down. So now, do they have to hike these economies into a place where a recession happens and unemployment rises just in order to get this inflation down? Seems like a possibility. Seems like a possibility. The more they hike interest rates, the worse it's going to be for the economy, and that will then get down inflation. But that will also cause unemployment to rise globally, which is just not happening at the moment. Labour markets are remaining strong. Well, inflation isn't really coming down the way people would hope, and that is where we are at on markets this morning. Oil, a lot of time will move with risk sentiment and hasn't pushed lower. Oil prices continue to push higher. Second straight weekly gain, which is a bit unfortunate. We were looking at that 67 round number that just has been respected again. You've pushed higher, so you can see oil prices slightly higher, on track for the second straight weekly gain, as resilient demand resulted in a larger than expected fall in US oil stocks, offsetting fears of higher US interest rates. So higher US interest rates cause a slowdown in economic growth. A slowdown in economic growth then means there is less demand for oil, which is then negative for the price of oil. But larger than expected falls in US oil inventories, a couple of weeks on the spin, proved positive for the price of oil. So I'll have a look at that again, that chart now in a minute. But we come across to the grid, pretty mixed regardless of where you look. Stock index in US down slightly, European bouncing back, Asia Pacific stock index is down, largely due to Chinese banking stocks. Chinese banking stocks down double-digit percentages over the course of this week due to higher interest rates and expectations for an economy not to grow, how markets had initially anticipated. So, the fact that the economy is showing a slowdown, the fact that interest rates continuing to put pressure on that, Chinese banking stocks are down, which has caused a bit of negativity across the Asia Pacific side of things. But that is not a handover from the US yesterday. Maybe a slight bit of a handover, but if it was a handover, you'd see global stock indexes down, Chinese banking stocks being down 10% on the week, and having a further rout over the course of this morning's Asian session is the contributing factor to Asia Pacific equity futures downside. Right, US bonds, you can see yields down across the board. Bonds bid, there's a bit of a pullback from yesterday, as we mentioned. Global bonds slightly mixed, so the bond picture slightly mixed. So broad-based US dollar strength yesterday. Has then a bit of weakness again. That is a bit of a pullback, which is not to be unexpected. You see Japanese yen strength. Asia Pacific equities down across the board has sparked some Japanese yen strength, and again the Japanese yen continues higher over the course of recent trading sessions. So a bit of a bounce back in that again, not unexpected off that 145 round number that we have looked at over the course of the last number of weeks. That has been respected. Price has pushed back down. Dollar yen did have a pop higher yesterday, but then dollar yen then back lower off the back of Japanese yen strength in this morning's session. The rest of the currencies across the board, the Swiss franc down slightly, but it's pretty, a couple of the currency pairs are just flat, and really a pretty choppy morning across FX, which is again not unexpected after the moves we had yesterday. We can come across to this and we can see the ADP employment change consensus 228,000 jobs to be added versus an actual of 497. So if we have a click into this and just look at this, that is the highest print. Highest print since July last year, but it is it was higher than July of last year. So the highest print in over a year in terms of these figures here, and you can see they're pretty consistent: 266, 262, 253, 261, 291, 267 in terms of the higher end of these figures over the last year. And then this just goes bang up of 500k. So that is a massive beat on expectations, and that caused some massive downside across the board in stocks. A massive downside across the board in stocks and bonds, and upside across the US dollar. You can see jobless claims held firm at the consensus, so that nothing too unsurprising there. We then did come into the afternoon when we got services PMIs. Now services PMIs higher than consensus again shows a resilient economy. Labour market resilient, services sector resilient. Job openings slightly lower than anticipated, but it's probably likely due to the fact that a lot of them were filled over the last month. So that's not job openings decreasing off the back of less jobs being open. That's probably job openings being decreased off the back of just more jobs being taken up. And that's kind of where we are at. You can see the crude oil stocks change, which is your oil inventories, which is a bigger draw than expected. Consensus just below 1 million, actual just above 1.5 million. So a reason for oil upside then across that. And that's sort of where we're at in terms of yesterday's trade. The US economy remaining resilient in the face of higher interest rates. You can see the S&P's version of the services PMI, the global services PMI, higher than anticipated. Composite PMI 53.2. So pretty positive figures across the board in markets yesterday. Now the fact you've got positive data across the board means that the Fed are going to continue being it means the Fed have more room to continue being aggressive in terms of interest rate hikes, and that puts pressure on stock indexes. Now if you come across to equities, you can see here big downside across the board. You look at the S&P, the Dow Jones, the Nasdaq, the Russell, all big downside. The DAX and the FTSE have been smashing lower over the course of the whole week. The FTSE even pointing towards fresh lows or through the lows of the overnight session into this morning, again making a further attempt lower. You can see the US 500, the S&P just trying to roll over again. You can see the Dow Jones, the Nasdaq, the Russell all trying to roll over again. The DAX trying to roll over again, and it's not a good picture for equities in the moment. You see the VIX as well. The VIX is still only at 15, only reached 17 yesterday. So the VIX has got room to the upside to continue rising, and if that continues rising, that causes further downside in stocks. So certainly not all rosy when it comes to stock indexes across the board. You can see US dollar strength yesterday. You can see your Aussie and your Kiwi obviously linked to those stock indexes. You can see dollar CAD pushing higher. Market's not really caring about higher oil prices, but they're the main downside on these assets. Main upside in US dollar. You can see strong downside in cable off the back of that. And you see euro dollar a bit choppy, but euro dollar is the one that was a bit choppy yesterday. Not too much to see there, but dollar yen had a spike higher, dollar Swiss had a spike higher. These couple are a bit tricky in the overnight session due to that kind of safe haven appeal. Slightly weaker US dollars this morning, slightly weaker US franc, but US franc, Swiss franc, but the main action coming from your Aussie, Kiwi and your CAD due to those risk flows. But really stock indexes is where you need to keep your eyes peeled. That US dollar trade ended up a bit tricky yesterday. Maybe NFP gets that moving today, but certainly my eyes will be on equities as we head into 1:30 p.m. today. Plus these bond markets, so you can see the spike higher in the yields, which is obviously bonds being sold, and that is globally. As I mentioned about the Aussie yields, about UK yields, all pushing higher globally. Obviously due to higher interest rates, or expected higher interest rates. Apart from that, you can see oil, we mentioned, a little bit higher. Gold, as long as yields keep rising, gold will remain under pressure. Look at Aussie yen, CAD yen going through the floor. Really risk off trading across the board wherever you look. But these bond yields, I can't imagine, if you're a trader of bonds, I can't imagine these bond yields go anywhere further than higher today. Bonds do anything other than getting sold, because if you think about it, like what do yields rise for? They either rise off expectations for the economy to improve, or rise off an improving economy, or they rise off the back of expectations for higher interest rates. Now, if you get a positive NFP print today, well, on one side of things, you've got the economy continuing to remain resilient. The longer that happens, the higher yields will go. If on the flip side, then if you get higher NFP, and it's markets are driven off kind of risk sentiment, and yields start to push higher off the back of expectations for higher interest rates. Well, stocks can go either way then off the back of that sort of thing. Now, positive economy is positive for stocks. Higher interest rates is negative for stocks. So then stocks you could look at either way, but on that side of things, if you do get a follow on from that positive data throughout the week, yields, whatever way you try and spin it, if stocks move higher off the back of expectations for economy to remain resilient, that's the reason where yields push higher. If you get a strong NFP print and interest rates, then markets price in higher interest rates, well, then that's positive for bonds. So any sort of a beat on NFP later on should be a trade lower on bonds, higher in yields. But stocks, due to the reaction yesterday, if you had asked me yesterday, I would have said they could go each way. But asked me today, off the back of that print yesterday, if we do get another beat on NFP today, and markets do if we get beat on NFP and the unemployment rate ticks down, surely that means the Fed keep the foot on the gas, and that guarantees a rate hike. Plus, I'd say yesterday's print probably guarantees a rate hike, but maybe that guarantees the potential for a back-to-back rate hike that the Fed did suggest only last week. So a bit to go off in terms of this morning's European session. As I said, that US dollar seems a bit of a difficult trade at the moment. Equities and bonds, probably where you should focus your attention into NFP later on.